So how do we use risk-based DCA or dynamic DCA to expose our dollars to less risk and accumulate more Bitcoin? Well, the approach is similar to traditional DCA, where you invest a fixed amount of capital at consistent intervals, say $100 every 90 days, regardless of the asset's price. This is a solid strategy for hassle-free market entry, but the price you pay is missed profit opportunities and that your capital isn't being deployed as efficiently as it could be. This is where dynamic DCA comes into play. In dynamic DCA, the investment amount is based on a specific variable. In our case, that variable is the AlphaSquared risk model. If we overlay risk on top of the Bitcoin price chart, this is what it looks like. As you can see on the left-hand axis, the risk level fluctuates between 0 and 100. In dynamic DCA, you increase the dollar amount that you invest for the lower the risk goes. Likewise, when risk starts to rise above a certain threshold, you gradually DCA out. This approach allows you to secure some profits early on just in case, while still saving most of your holdings until the risk is high. So let's look at a practical example of risk-based DCA or dynamic DCA. Let's say your baseline monthly investment amount is $100 and you want to invest when the risk is 40 and lower. Then you might invest your base amount at a risk level of 40, 2 times your base amount at a risk level of 30, 3 times your base amount at a risk level of 20, and so on. This dynamic approach enables you to invest more when Bitcoin is undervalued and less when it's overheated. The outcome is a lower average cost and more Bitcoin per dollar invested. The selling strategy works the exact same way. For instance, if you've accumulated 1 BTC, you could sell 0.1 Bitcoin at a risk level of 60, 0.2 Bitcoin at a risk level of 70, 0.3 Bitcoin at a risk level of 80, and so on. By doing this, you will always secure profits that can be reinvested for compound profits, but you also save the majority of your stack until the higher risk areas. You can, of course, adjust these multipliers and cutoff points based on how aggressive you wish to be with the model. But again, remember that the model is a macro model. It won't perfectly classify a top or bottom on the dollar, even though it has done a great job so far. Therefore, waiting for a risk level of exactly 100 or exactly 0 is not guaranteed and could be a very risky move. Now, if we test a simple version of dynamic DCA and regular DCA in the AlphaSquared backtesting environment from 2016 to 2023, we get the following results. As you can see, simply adjusting your investment amounts and slowly taking some profits during high risk areas can significantly increase your long-term BTC holdings and profit. So to build a risk-based strategy, you need to understand 2 things about yourself. The first one is your personal risk tolerance, and the second one is your personal philosophy on Bitcoin. Do you view Bitcoin mainly as a technological innovation with the aim of accumulating without selling, or do you see it more as an investment vehicle intending to eventually convert your gains into fiat? So make sure when you build your strategy in the AlphaSquared platform that you take these things into consideration. Now, at this point, you're probably wondering what's risk and how is it calculated? Understanding risk is fundamental to leveraging it properly. So let's establish what risk is. In essence, risk is a score between 0 and 100 that serves as a snapshot of the current market risk. The algorithm, which was built in early 2021, analyzes a huge amount of data and market variables that affects the dollar value of Bitcoin. It's rooted in things like asset growth theory, statistical modeling, regression, technical analysis, etc. It is very important to note that this is a long-term risk metric. It's not a trading indicator or a buy-sell signal generator. And here we can also recognize the model's dynamic nature. Note how the same price can correspond to different risk levels at different points in time. And this means that even if Bitcoin in a future bear market is trading at $60,000, the model's dynamic capability could still assign it a low risk score of 10, for example. So the model adjusts itself and adapts to market conditions over time. So now you know the technical foundation of our risk model, but why does it work? And how is it so effective at mitigating the downsides of DCA and improving profitability? while most retail investors, likely including yourself, began investing in Bitcoin at a price that you shouldn't have. We can see this by looking at the spike in downloads of crypto exchange apps whenever Bitcoin reaches a new all-time high, for example. There are two main factors responsible for this. The first one is greed. The majority of retail investors enter crypto during a bull market, which ironically is when they should be getting out. But the upwards trend and continuous hype that never seems to end lead to a very clouded judgment. The second factor is speculative forecasting. During the last bull run, you probably heard claims that Bitcoin would soar to 100K, 300K, or even 500K. However, the cycle ended at 69K, causing a lot of pain and financial loss to a ton of people. So how does the risk-based approach address these issues? First, with the risk model, we're ignoring the fear, avoiding the hype, and trusting the data. The model is exclusively data-oriented and does not take any subjective assumptions into consideration, such as predictions or prophecies. So whether the markets are butchered or reaching new all-time highs, the risk model allows us to stay objective. Second, the risk model operates on a classification-based approach, not on predictions. We are not interested in speculating about future prices. We simply don't care. Our primary concern is simple. Is it at this point in time a risky asset or not a risky asset? If you think about it, you don't really need to know when the next major top or bottom will occur or at what price it will happen. All you really need to know is if it is happening right now. And that's where risk classification excels above any other strategy. So by now, you hopefully understand what risk is and how to use it. As a member, you can backtest your own strategies and compare it to regular DCA to optimize your risk-based approach. AlphaSquared is also the only one in crypto offering forward testing using price simulations, which we'll discuss in a future video. If you have any questions or just want to discuss strategy with other members, feel free to join our Telegram channel. Thanks for watching and talk to you soon.